Through this analysis, we will examine Altech as an investment opportunity and highlight what aspects we believe will support and potentially improve the company's long-term valuation. Over the last number of years, high-purity alumina has seen strong growth in demand, which has primarily been driven by LEDs, as they continue to become more widely adopted as a preferred lighting option. But with industries that rely on HPA expected to boom over the coming decade, including the lithium-ion battery and smartphones, demand for HPA has been forecasted to potentially triple by the year 2024. And whilst this increase in demand could see further appreciation of the long-term HPA price, Altech, through their revolutionary hydrochloric acid processing technology, which uses kaolin as the feedstock, will potentially become one of the lowest cost producers globally. As current producers, which are dominated by chemical companies or multinationals, produce HPA through a highly expensive, multi-stage processing methodology. By contrast, Altech will establish itself across the entire value chain from pit to end HPA production. And given the low forecasted operating cost, our sensitivity analysis highlights the significant upside in our valuation, even when our costing assumptions are increased significantly compared to the BFS. And whilst there are multiple factors that have combined to drive this low forecasted operating cost, the underlying factor for this is the company's 100% owned Meckerin kaolin deposit. Meckerin is located approximately 130 kilometres from Perth in Western Australia, which has allowed the deposit to be supported by all essential infrastructure requirements, including power, water and roads, a skilled workforce, as well as a port facility within close trucking distance. However, the key factor that makes Meckerin so unique is that there are very few impurities in the deposit, most notably extremely low iron and sodium levels, which has allowed the deposit to be amenable to the revolutionary processing technology to produce HPA. And with a current resource, which supports a mine life in excess of 250 years, provided a successful implementation of the project, it is probable that the company will consider expanding production in the future. For any commodity that is not traded on a designated metal exchange, possibly the most important aspect prior to production commencing is for an offtake agreement to be in place. Without offtake, there is no guarantee that production will be sold, and it is unlikely that project financing would be available. Aware of this, Altech made offtake a priority and has secured a global offtake agreement with Mitsubishi.
The 10-year offtake agreement with Mitsubishi is important for us because it helps with the financing, the debt financing going forward. It helps with our distribution and marketing. As you know, Mitsubishi is a very large organisation. They have a lot of marketing and selling infrastructure throughout Asia Pacific. We tap into their shipping and distribution network, which is very important for us, and we see them as a very worthy partner going forward.
So with offtake secured, project financing expected to be completed early this year, and potentially one of the lowest cost HPA operations globally in a growing market, the threat of a takeover from a competitor chemical company or potentially an end user of HPA is possible, especially when Altech continues to trade at such a significant discount to their long-term valuation potential.